Insurance can get cheaper as you get older. In this educational video episode, I'm going to address how IUL insurance costs reduce as the insured gets older. Get ready. A lot of financial advisors do not have a clue about this phenomenon. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 48 years, helping people optimize their assets, minimize taxes, and prepare for a comfortable retirement so that they will not outlive their money. So one of my big goals for retirees is to make their retirement nest egg immune from the negative impact of taxes, inflation, and market volatility. If you've watched very many of my educational episodes on this three-dimensional wealth channel, you'll soon discover one of my favorite financial vehicles, bar none, to allow people to accumulate their money tax-free and then be able to access that money income tax-free even before retirement. And then when they ultimately die, whatever's left behind blossoms and increases in value and transfers income tax-free is what I call the laser fund. And LASER is an acronym that stands for Liquid Asset Safely Earning Returns. In fact, it's the title of my 11th book that's been flying off of our warehouse shelves. I want to gift you a copy of this 300-page book at the end of this episode, so stay with me. So in this episode, I want to explain how a life insurance contract, a life insurance policy, when it's designed to do what I talk about in this book, it actually gets cheaper as you get older. There's a lot of financial advisors and even insurance agents that do not understand how or why this phenomenon occurs. So let me explain how it works and a little bit of the history behind it so that you can understand how this can be an incredible alternative for maybe 40, 60, 80%. Some of our clients, 100% of the retirement income comes out of a portfolio of laser funds because it's 100% tax-free. Now, if you're not aware, under three sections of the Internal Revenue Code, Section 72E, 7702, and 101A, money inside of a life insurance policy, a permanent life insurance policy, grows tax-free under 72E. You can access the money if you do it the smart way under Section 7702. And when you ultimately pass away, if I died tomorrow in an accident, every million would blossom to 2 million, increase in value and transfer income tax-free to my spouse, my kids, my grandkids, my estate, whatever, a church or a charity, whoever I want. Nothing else I'm aware of does that in the Internal Revenue Code. So it's one of my favorite instruments, but then people, critics, many times whole life insurance agents will say, well, golly, whole life has guarantees. Now, those guarantees used to be 4%. They're going down. And actually, universal life does have features and guarantees, and such as a no lapse guarantee, where you can make sure that your money and that death benefit does not trigger unnecessary tax. But folks, let me illustrate simply here how the insurance component of universal life can get actually cheaper as you get older. And again, many people don't understand this. So I'm going to simplify it. Back in 1980, when E.F. Hutton, who is the original brainchild, credited for the emergence of universal life, in 1980, they said, hey, why don't we take the least amount of insurance the IRS will let us get away with and put in the most money, premium, that the IRS allows, and this thing will turn into a tax-free cash cow that will knock the socks off of most IRAs or 401ks invested in the market, even if your money is earning an average of 12%. Because if you're earning 12% in a tax-deferred IRA or 401k, and you start taking out income, a third of that's going to go out the window in taxes based on the average American. And so if you're earning 12, you're only netting 8, and you subtract another 1% for fees, you're only netting 7. The fact of the matter is most Americans are not averaging 12%. They're only averaging 9 and netting 6 or even 4 and netting 3. With max funded indexed universal life, I have earned 11 and netted 10, many 20-year periods. I've averaged 9.62%. And that is totally income tax free. So, how do I make sure that this insurance policy will not, as they say in the industry, crash and burn, run out of money because the costs get so expensive? Because a lot of ill-advised advisors, they say, oh, the cost of insurance keeps going up. It's going to go through the roof and this thing's going to run out of money. It's going to implode. Well, okay. Now, the insurance component of a permanent life insurance policy, be it whole life or a universal life, the actual cost per thousand of life insurance goes up every single month you get older. I mean, hello? Yes, every month you get older, the cost of insurance, the number of people dying per thousand as they continue to age goes up. Well, what you're doing with a properly structured max funded indexed universal life, your objective is living benefits, not so much the death benefit. So let me use an example. A 60-year-old male who wants to use an indexed universal life, if they wanted to have the least amount of insurance the IRS would let him get away with, it would be about double what he wants to put in there. So let's say he wants to deposit $500,000 into an indexed universal life to be used to generate tax-free income in retirement. Now, if you want to generate tax-free income, you can't put in the entire $500,000 at once. If you do, it will only grow tax deferred, and then when you access money, it will be taxable. So most people want to comply with IRS rules because this is not some secret. The IRS knows all about it, and they say you have to put it in over a 5-year period or about $100,000 a year if you're over age 50. This is called the TAMRA tax citation, TAMRA, which is an acronym that stands for the Technical and Miscellaneous Revenue Act of 1988. So if I'm going to put in $100,000 a year, let's say for 5 years, I would have my total of $500,000 into the IUL policy. Now, the objective is to earn the highest rate of return. At age 60, the amount of insurance I could get away with would be about double $500,000 or $1 million. Now, I could buy way more life insurance than $1 million. That's not the objective. I want the least amount of insurance so that it stays tax-free under those 3 sections of the Internal Revenue Code. So I'm going to put in $500,000 over the first 5 years, and the minimum amount of insurance is $1 million. So far, so good. Now, the beauty of maximum funded indexed universal life, if you're going to use it for living benefits, you want the cost of the insurance to get cheaper as you get older. So as I put in $100,000 a year every year for the first 5 years, the difference between the original death benefit, the $1 million, and the cash that I'm putting in is the net amount at risk. So if I put in $100,000 and if I died the next day, okay, then the $100,000 I put into it is part of the $1 million the insurance company pays out. Even though I have the option of having my premiums paid out on top of it, that's not what I want. If I'm going to use it for living benefits, I want the insurance costs to go down. Now, if I put in 200, 300, 400, 500, let's go to the 5th year. You've got $500,000 of your money into a $1 million life insurance policy. Plus, you're going to have some interest on that, but $500,000 of cash value is now half of the death benefit. The net amount at risk if you died is the remaining $500,000. The insurance company is only at risk to pay out $500,000 out of their pocket because now half of the $1 million that is the death benefit if you die is your own money that you've put in there, the cash value that is sitting there. Does that make sense? So the insurance company is only going to charge you for the net amount at risk. In the 5th year, they're only charging you for half as much life insurance as they did 5 years earlier. Is this making sense? Now, based upon the average rate of return that I've experienced for the entire 42 years that these have been around, 9.62%. Let's round it down to 9.6. Your money will double every 7.5 years. This has been true for many, many people like me. And so 500,000 in 7.5 years, so that might be in the 12 and a half years from when I started. My cash value of 500,000 in the last 7.5 years is now doubled to $1 million. Wait a minute here. In 12.5 years, I have $1 million of cash value, and the death benefit was only $1 million to start with. What's the net amount at risk? Zip. Okay, I'm self-insured. We call it self-insurance. There is no cost for the insurance, but in order for the money to continue to grow tax-free, the IRS says the death benefit has to stay 5 percentage points ahead the rest of your life as your money grows. So if you died in 12.5 years into the policy, in this example, the death benefit would be $1,050,000. But the insurance company is only charging you for the remaining $50,000, not $1 million of death benefit. Let's say in another 7.5 years, so that would be in 17.5 years into this, the million has doubled to $2 million. If you died in that point in time, the death benefit would be probably $2.1 million, $2,100,000. But the insurance company is only at risk for that $100,000, that 5% cushion. And so they only charge you for $100,000 of insurance. Do the math. The interest you are earning on your $2 million is so much greater than the cost of $100,000 of death benefit, even though you're 17.5 years older, that the older you get, the cheaper the insurance becomes. If you were to calculate your internal rate of return in the 20th year and the 30th year, you might earn 11 that year and net 10.9. If you earn 10, you would net 9.9. The cost of insurance is down to 0.1% of your interest, but I usually just average it. If you were to die 20 years, 25, 30 years into a policy, and you retroactively calculated the cost of the insurance, it's usually around 1%, retroactive back to day one. So as a long-term cost, the insurance maybe used one of your percentage points. That's why I usually say if I've averaged 11, I've netted 10. If I've earned 16, I net 15. If I earn 8, I net 7. And so the cost of the insurance is only about one of those percentage points, which is frankly money that would otherwise have gone out the window in unnecessary income tax. So does that make sense? As your cash value grows, the net amount at risk goes down, and pretty soon your cash value equals or exceeds the original death benefit, and the death benefit now grows 5% ahead of your cash value. This is how it gets cheaper as you get older. If you want to learn more about this, study this book called The Laser Fund. Here's how you can claim your free copy. Simply go to laserfund, L-E-S-E-R, fund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will pay for the book. It's 300 pages. It's actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations. If you're more of a right brain learner, you learn by stories, you flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories of how this is the dream solution for many goals, not just retirement, college funding for your kids and grandkids, working capital for business, real estate management, and on and on and on. If you want to use both your right brain and left brain, read both of these books. But this is about you and your brighter future. You contribute a nominal amount. I'll cover the rest of that cost. I'll pay for the book. There's options there if you want to listen and learn, watch and learn. Check out some of the online educational webinars that we do on a regular basis. You can even schedule an appointment to talk to a specialist that can help you understand how a laser fund can work in your particular set of circumstances. So here is to your brighter future.